Hey there, welcome to Capital Gains. With the whole Israel-Palestine situation heating up, some economists are getting a bit worried. They're thinking this conflict might have some serious effects on the US financial scene. Big names like Peter Schiff and other experts have been looking into possible scenarios, and here are the top 10 things they're keeping an eye on. 1. The conflict spreading into a full-on regional war, dragging the US directly into the mix. 2. OPEC hitting us with an oil embargo as a response. 3. Iran deciding to block the Strait of Hormuz, messing up oil transportation big time. 4. Oil prices going through the roof, hitting $300 per barrel. 5. Europe dealing with a major energy crisis because of a shortage of liquefied natural gas. 6. Global inflation going up because energy prices are skyrocketing. 7. Damage to the US financial markets and banking sector. 8. The US debt crisis spreading, making the Federal Reserve take some serious financial rescue actions. 9. The petrodollar system facing a threat, which could mess with global financial markets. 10. The US possibly dealing with severe inflation, kind of like the Great Depression in the 1930s. In a nutshell, as the Israel-Palestine situation keeps getting more intense, the US might have to tackle at least 5 major financial disasters. And this worry is extra important because the US government is currently stuck in a bit of a deadlock over funding to handle conflicts happening all around the world. So, buckle up. It might be a bumpy ride. Meanwhile, let's talk about China. They're making some interesting moves. As the second largest holder of US debt, they're actively getting rid of US Treasury bonds. Now, this catches attention because China is a big player in global trade, being both the largest importer and exporter of goods. If they start favoring currencies other than the dollar, like the renminbi, it could have a serious impact on US debt and the dollar's standing as a reserve currency. Recent data from the US Department of the Treasury shows that China has been consistently selling off US Treasury bonds for the past 5 months. By the end of August, their holdings had dropped below $805.4 billion, the first time going below the $810 billion mark since May 2009. Not only that, but they've been reducing their US Treasury holdings for a solid 11 months since December 2021, showing a steady and uncommon divestment pattern. Here's the kicker. China has net sold a whopping $51.3 billion worth of US Treasury bonds. To put it in perspective, that's roughly equivalent to the total US Treasury holdings of the third largest holder of US debt, the United Kingdom. It even surpasses the US debt holdings of America's allies like Germany, France, and Italy. So, in the past decade, China has become the biggest international seller of US debt. But wait, there's more. China is not just ditching US Treasury bonds. They're also playing a strategic game by shifting a significant chunk of their holdings into gold. According to the latest data, they've been boosting their gold reserves for 11 consecutive months, starting from November last year. That's a notable departure from the previous pattern, where their gold reserves remained stable at around 1,948 tons for 40 months since July 2019. Now, China stands as the world's largest buyer of gold, while simultaneously being the largest seller of US Treasury bonds. According to a report by the World Gold Council, China has imported a total of 1,081 tons of gold from January to August this year. When you add their consistent increase of 243 tons in gold reserves since November, it sums up to at least 1,261 tons of gold imported to China from the US and Europe. That's becoming a crucial part of China's domestic gold reserves. Quite the strategic move, don't you think? Here's an interesting twist. Switzerland, renowned as the world's largest gold refining and transit hub, decided to part ways with US Treasury bonds in August, totaling a hefty $18 billion. What's intriguing is that they made this move even in a month when the US sovereign credit rating took a hit. The Swiss National Bank, known for its keen currency sense, basically showed some doubt about US Treasury bonds. So, in August, Switzerland took the spotlight as the biggest international seller of US Treasury bonds. This could be a hint of a fresh wave of US debt divestment, especially as the US government and Congress are on the lookout for more funds to deal with geopolitical issues worldwide. Analysts are suggesting that Switzerland might set off more selling of US Treasury bonds. With the US government seeking extra funds, a limited supply of US debt financing might kickstart a butterfly effect, leading to higher inflation. While the US Consumer Price Index had a slight drop from its peak of 99.1% last year, inflation has made a comeback in the past 2 months. This resurgence is causing concern among a growing number of Americans who are wrestling with rising prices and developing worries about inflation. Notably, on October 16th, Peter Schiff pointed out that the US approach to inflation lacks transparency. The root of the problem lies in the fact that the US economy has heavily relied on unrestricted debt support for an extended period. This support isn't just from the federal government, but also from individual states, local governments, US businesses, and households. Basically, everyone has been on a debt-driven spending spree. Here's the backstory to this debt-driven spending spree. The Federal Reserve's decision to consistently raise interest rates over the past 20 months created a situation where the US economy got caught up in a debt trap. Before 2022, the Federal Reserve introduced loose monetary policies, setting the stage for the debt entanglement we're witnessing now. Every aspect of the United States is now weighed down by debt that seems unlikely to be paid off. Since March last year, the Federal Reserve has upped interest rates 11 times, pushing the federal benchmark rate from 5.25% to 5.5%. This move has cranked up the interest costs tied to various US debts. Just last year, interest costs on US debt shot up by at least 40%, and this year, the estimated interest expenses have gone beyond $1 trillion. Janet Yellen, the US Treasury Secretary, recognizes that US debt interest eats up 98% of economic output. While she insists the debt is manageable, she reluctantly admits that higher interest rates might stick around, and our fiscal situation isn't without challenges. Yellen even warned that at current rate levels, US debt could become unsustainable, facing the risk of a global liquidity crisis. From a global perspective, even if the Federal Reserve becomes the largest buyer of US Treasury bonds in the future, the US debt-dependent economic model lacks global liquidity, so the fate of this economic model essentially rests in the hands of China, the second largest holder of US debt. Recently, the US House Financial Services Committee gave a heads-up to Treasury Secretary Yellen, asking her to brace for the possibility of China divesting $800 billion in US Treasury bonds. Analysts are speculating that China might continue divesting around $7 billion, bringing US debt holdings down to the billion-dollar level. This paints a less than rosy outlook for the US debt-dependent economic model. And that's a wrap for today's video. Don't forget to like, subscribe, and hit that notification bell to stay in the loop about developments in business, finance, investing, economy, and other news shaping our global financial system. Thanks for tuning in, and we look forward to having you with us in our upcoming videos. See you next time.